Unlike all other endeavors, Tesla is not a flawless firm. There are observable problems that could jeopardize Tesla's revenue and profitability. These have been brought up numerous times, particularly by analysts and specialists on electric vehicles. It appears that there is a serious issue that can once more have an impact on Tesla and its investors. This was revealed by Tesla bull Ross Gerber in a recent interview, wherein he stated that this is one issue that can negatively impact Tesla's earnings and consequently its shares. Welcome back to Tesla Tomorrow, everyone. The main issue facing Tesla, according to Ross Gerber, is that the company had a lower pricing, which impacted profit margins even as it raised demand. Tesla started a pricing battle in January when it cut prices by up to 20% on a global scale, despite missing Wall Street delivery projections for 2022. Following comparable price reductions, Tesla drastically lowered the price of all of its models in the US and the Model 3 and Model Y in Europe. A few days prior, the company allegedly made cuts in China and Asia to increase demand and ensure that more of its cars qualified for the new EV tax credit under the Inflation Reduction Act. However, investors were concerned about erosion of margins even though they thought price cuts would encourage sales. Why is Ross Gerber concerned about Tesla's price reduction so much? Before we begin, please click the like button if you enjoy this kind of stuff. Let's find out. Turn on alerts and subscribe to our channel to keep informed about all that Tesla is doing. Although the company's objective was a 50% rise, Tesla only produced 1.31 million vehicles last year, up 40% from 2021. Musk has blamed the failure on the financing rate set by the Federal Reserve. The business was also beset by other difficulties, such as heightened rivalry from major players like Ford and production troubles at Tesla's Shanghai plant. Due to a decline in both sales and delivery rates, Tesla was forced to lower its car prices in a few of its locations. This was carried out to increase demand for Tesla automobiles. Yet, Tesla bull, according to Ross Gerber, Tesla will have significant challenges in the future that could impact its profit margin, particularly if it is unable to sell 50 additional cars at a higher profit. Other experts have also responded to Tesla's price reductions, and many of them thought the reductions would boost demand for Tesla. Bush evaluation recently, Dan Ives stated that although there will undoubtedly be a loss on profits, he thought this was the right thing to do at the appropriate moment to increase demand for electric vehicles. In the EV arms race, Musk continued, it's time for Tesla to show its strength and lower prices. However, the immediate response to Tesla's high-priced negative cuts are expected, and the stock may be undervalued. Today, Tesla is expected to be more globally distributed than ever. The analysis by Morgan Stanley Adam Jonas explained to clients that Tesla is using the significant price reductions to take advantage of its market dominance and exert pressure on rivals in an EV deflationary environment. For Tesla to maintain its competitive edge, it will be essential to maintain its size, significant cost and technological leadership, and bank sheet. In addition to reiterating his overall overweight rating, Jonas stated that he sees Tesla as a winner amid a difficult worldwide reset of EV expectations. Given that both established and emerging automakers are making significant investments in electrification, the demand for electric vehicles is rising, and governments are continuing to provide incentives for both ownership and manufacturing. Morgan Stanley is fairly bullish about Tesla's prospects in the EV market. Consequently, it is anticipated that by 2050, Tesla's percentage of worldwide auto sales will have increased from approximately 7% at present to over 90%. The firm pointed out that while the much-anticipated shift to a worldwide car market dominated by EVs is still probably decades away, there may be many opportunities for long-term investors to profit along the way, even though the current rate of EV ownership is very low. According to Morgan Stanley's research, as electric vehicles, EVs, become more inexpensive, the percentage of consumers who would like to buy an EV or a hybrid vehicle would probably increase from 29 to 24. According to the report, EVs could soon become as affordable as gas-powered vehicles. At around $65,000, they are currently out of reach for many consumers. However, with continued advancements in performance and battery costs falling, the average price of an EV could drop to $18,000 by 2025. Compared to the equivalent gas-powered car, that is less. Additionally, there has been a significant shift in public policy in support of decarbonization. 24 states in the Union, as well as the District of Columbia, have implemented clean car laws that include progressively stricter emissions regulations, rebates, and other financial incentives for zero-emission cars and associated infrastructure. Currently, Regulations pertaining to fuel economy and exhaust CO2 emissions apply to more than 85% of automobile sales worldwide. In their preview of Tesla's Investor Day, Morgan Stanley analysts stated that they were excited to see Tesla introduce a range of technologies that would be needed for the widespread use of EVs at a significantly reduced cost. The experts with a $220 price and an overweight rating speaking about Tesla's recent pricing. Target on the stock stated that this is a crucial part of Tesla's Master Plan 3, which Musk stated earlier this year will be the fully sustainable energy future for us. Slices. According to Morgan Stanley analysts, Elon Musk has consistently emphasized the company's aim of becoming a mass market maker of electric vehicles and bringing down the price points required to make a significant dent in the global auto installed base's carbon footprint. They think it's feasible, but in order to keep their industry-leading margins, Tesla will need to successfully reduce the average price of their goods and preferably reduce costs as well. The analysis indicated that Tesla will need to significantly reduce its current cost per vehicle in order to meet its goal of producing a competitive car at a price point of $25,000. They went on to say that the Model 3's updated interior and ensuing advancements might be a positive move. According to Morgan Stanley's study, Tesla's price goal is $220, although this isn't including the sale of a Cybertruck. Adam Jonas maintained a buy rating for Tesla in a report that was made public. Apart from Morgan Stanley, Barclays also made a purchase of Tesla. The majority of Tesla analysts and investors were alerted to a report on May 13th, which raised concerns that the company might not be able to generate enough revenue from its recent price reductions. Consequently, the choice of whether to raise prices and risk losing market share or to maintain low prices and make less money temporarily persists. Well, that is a decision best left to the automaker. Barclays' evaluation Dan Levy anticipates that since other automakers have matched the price reductions and worries about a flagging economy continue, Tesla would face pressure to drop costs even more. Tesla's cost China's price war began when cuts were implemented, and now rivals like BED and Xpeng are lowering their prices to maintain market share in the face of declining demand. Musk has previously warned that the possibility of a recession and rising interest rates mean the EV manufacturer may also lower prices to maintain growth at the expense of profit in January. Cuts had fueled demand, and in anticipation that the automaker would win the price, Tesla shares had surged more than 68%. Since the war has begun, it is highly likely that Tesla will reduce prices once more. The automaker is gaining market share, and other EV companies, especially startups, cannot afford to continue selling at exorbitant costs and risk losing out on business. A concern that can arise for investors, though, is whether Tesla can sustain the decline in earnings and its profit margins, particularly given that the CEO is now partially involved in the business due to his dual positions as CEO of SpaceX and Tesla. Given Elon Musk's dedication to neurotechnology, tunneling projects, and now Twitter administration, it's difficult to see how his schedule could possibly include personal affairs, preserving free expression, and other purportedly significant initiatives. It's possible that Tesla needs its CEO in full Tesla bull now more than ever, since even the CEO acknowledges that his workload has recently increased quite a bit. According to Ross Gerber, short-term investors may be quite concerned if Tesla stock does not rise well in the near future if earnings are not raised. But what are your thoughts? Please share your thoughts with us below, and don't forget to share your Tesla valuation with us. Please click on the following video to see more about what Tesla has been up to in the previous few days. Talk to you there.